What is going on, traders? Welcome back to the Traveling Trader. So we have some upcoming catalysts and indicators that might be pushing the market one way or the other. In my view, there are four main ones to be exact, and I will tell you what all four of those are in this video. Now, some of these variables are competing, and I do believe that the market could see an imminent drop in the short term if the negative catalysts overtake the positive ones. However, overall for 2021, regardless of what happens in the short term, I think it is still going to be a bullish year with record GDP growth. Now, what happens in 2022 is a story for another video. So if you're new to the market, you might be confused about all this talk regarding bond yields and the Fed. I promise you I will simplify it for you in this video. So if you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of these potential catalysts and whether you agree or disagree with my premise. And sign up to our trading group where it's not just a 24/7 moon party. We are actually very realistic and pragmatic when it comes to the market. Most of these YouTube channels who have no business talking stocks, in my opinion, they have no idea what to do when the market gets choppy. Everybody's a genius in a bull market, I'll be honest, even me. But do you know how to set stop limits? Do you know how to hedge your positions with buying calls on something like the VIX? Do you know how to sell calls against your shares that you want to keep? Do you know how to sell cash secured puts on stocks that you want to own but don't want to pay current market prices for? All of this are things that we cover in our trading group on a daily basis. So it's a great value. You definitely want to sign up. And if not, I appreciate your viewership nonetheless. Let us get right into it. So the first thing I'll talk about is the VIX. Now, for those of you new traders, the volatility index is exactly what it sounds like. It is just a popular tool used to measure the expected volatility of the stock market. Now, why is this important? Well, because if you look going all the way back to February, which is pre-COVID crash, you'll see that there is a support level that we've established here, and we've bounced off of this support every single time that we touched it. We did it in August, we did it in December, we did it in February, and we're doing it now. We haven't bounced yet. So this is important because the less volatility there is, the more that a stock market grows gradually. Usually this spikes when the market tanks. So now that we've hit the support level again, if the VIX is going to actually spike from here and bounce, then we expect the market to tank. This support was also the previous resistance pre-COVID. So I'm going to be watching this very closely because if we do actually end up breaking support, this is a good thing for the market. There's an inverse relationship between the VIX and between the bullishness of the market. So if we actually do break this support level on the VIX, then the market will have a chance to rally. And that means that the market in general, for the first time since COVID, is expecting less overall volatility. Now, one of the things we did was actually buy calls on the VIX, as I mentioned in the beginning of the video. Did I mention it? I don't remember. I might have. But anyway, one of the things that we did was buy calls on the VIX, meaning that we're expecting, not really expecting, but we're using it as a hedge. So if the VIX does actually bounce from there and the market does see a drawdown tomorrow, then we can collect some premium against our holdings. So we came in here and bought the 21 calls as a hedge and bought them for around $1.60. Now, the honest to God truth is I do hope that I lose money on these because it's a hedge, so it's much less than my overall portfolio. So if we actually do break the support on the VIX, then I expect the market to be gearing up right now for another bull rally to last until the end of 2021. And I would much rather have that happen than just make money on my hedge, but having my overall positions be down. Okay, catalyst number 2 that you should watch is the Fed meeting that is on Wednesday, March 17th. I had to look at the date. So Wednesday, March 17th, you want to make sure that you tune in to Jerome Powell's speech, and everybody's going to be tuning in. If you were involved in the market on Tuesday, March 16th, then you likely saw some choppiness. What this is investors basically waiting it out to see what the Fed does on Wednesday. Believe me, everybody is going to be on pins and needles waiting to see what Jerome Powell is going to say. Now, what can he say that would tank the market? Well, one, he can say that he's going to start raising rates, unlikely, but if he does, believe me, the market will tank in the short term. Two, they're going to be looking at some of the economic data that he releases, whether to see if the economy is really reopening in the way that people are expecting or if it is a less than stellar outcome so far. And three, what I want to see is what are they going to do with bond buying? And here is where we start getting into bonds. But don't worry, I'm going to explain it to you in a very short and easy way. Okay, so what are bonds? Bonds are just notes, like promissory notes, that the government issues to a bond buyer, whether it's the Fed or a foreign country or a retail investor like us. And let's just say that this bond is worth $1,000, right? So what this means is that the government will sell this to somebody for a price. Let's just say that, let's just take us for instance, right here. This is us. This is the lowly retail investor here. And the government sells us this $1,000 bond, meaning that in the future, we'll be able to cash in this and get $1,000 from the government. So obviously they're going to be selling it to us at a discount. So let's just say that the bonds are now selling for $950. And bonds are a market, just like stocks, just like options, so they run on supply and demand. So the government's gonna sell us this $1,000 bond for $950, and they say, hey, in 2 years, we're going to be giving you $1,000. So how much would we be making on our money? Well, obviously we bought it for $950, we're gonna cash it in for $1,000 when the time comes, so that means we're making $50 on our investment. So what is our percentage gain? Well, if we spent $950 and we're making $50, that means that I think it's around 5%. Let me see, 1,000 divided by 950. Yeah, so we made 5.2%. Now, nobody's getting anywhere near that. You hear that the 10-year rate is like 1.6 now. But anyway, this is just for example purposes. Now, what happens if nobody buys these bonds? Oh, I forgot to write the percentage down. So that is 5% on our money roughly, okay? Now, what happens if nobody buys these bonds? Well, if nobody buys these bonds, then obviously the government is going to be incentivized to sell them cheaper. So let's just say that they're now not $950, they are actually $900, okay? So if they're $900, what is the effective yield, the rate of return? Well, if we pull out our trusty calculator, that means if we bought the bond for $900 and we get to cash it in for $1,000 when the time comes, now our yield is 11% instead of 5%, right? So this is what it means when bond yields are increasing, is that due to a lack of demand, the government has to basically lower the price of bonds, or the market. It's driven through market forces, right? But anyway, the price of the bonds will go down. So there's an inverse relationship between the price of the bond and the actual bond yield. So if nobody's buying bonds, then the bond yield is going to go up. Now, the 10-year Treasury note, which is the one that everybody references, has an effect on things like mortgages, like conventional loans, like corporate loans. So if the 10-year note goes up, then the cost of borrowing money goes up as well, which is not good for growth stocks, which is why you see growth stocks like NASDAQ stocks declining when the bond yields rise. They are growth stocks. It's built in the name, meaning we expect them to grow at a certain percentage every year. But now if the cost of borrowing money goes up, then that growth is essentially diminished. Now, why are people not buying bonds? Well, because if people are afraid of inflation, who wants to lock up their money for 10 years at 1.6 or whatever the rate is now, 1.6%? Who's going to lock up their money for that long? That's why Warren Buffett said bonds are a terrible investment, because they barely make enough to beat inflation. So if we expect there to be more inflation because all of this helicopter money, then bonds become less attractive. So the bond yields will have to go up in order to incentivize people to buy bonds. Now, the Fed has been buying bonds and buying a lot of other shit too, but they've been buying bonds for sure. However, they have been disinterested in the 10-year bond. They really haven't upped their purchases of the 10-year Treasury. So if, for instance, Jay Powell comes on Wednesday and says, hey, guess what? We're going to be buying some 10-year Treasury notes as well as some other notes. We're going to be increasing our buying. Well, then the market will see a boom because of that, because they're going to be buying those bonds. In effect, the rates will go down, much as I described in our little scenario down here. And that is good for growth stocks and the market in general. So we're going to be keeping our ears perked up very closely to what Jerome Powell is saying. If they do not increase bond buying, if they increase the Fed rate, again, unlikely. The Fed rate currently, by the way, is near zero. And the Fed rate and the bond yields are not the same thing. So a lot of new traders think they're synonymous. They're not. They're completely separate. So the Fed rate currently is effectively zero, and I don't think he's going to raise rates. But if he does, then expect the market to crash. They will, however, need to raise rates in 2022 or for sure in 2023, as they said they would do, because raising rates fights inflation. All right, the third catalyst, which is a bullish catalyst, is that most stimulus checks will be issued on Wednesday, March 17th, which happens to be the same date that the Fed is talking. I'm sure that was planned, even though they'll say that it wasn't. But that is what I was talking about with regards to potentially competing narratives. Now, I expect the stimulus checks to be deposited without a hitch. We've had certain problems with certain banks, but I think those are edge cases. In general, I do expect most of them to be deposited. Now, what's interesting is there was a survey by, I believe, Deutsche Bank that said that 50% of that money potentially is going to make it to the market. So I expect a fresh round of liquidity, much like we saw the first time. I mean, I think we saw something crazy after the first stimulus, like 13 million new Robinhood accounts open. And for sure, a lot of that stimulus money did make it to the market. I also think Bitcoin's price is going to go up because of it, but that's another topic. And the fourth and last catalyst that is also bullish is pretty stupid. It's St. Patrick's Day. And St. Patrick's Day has historically been, for some reason, been an insanely positive day for the markets, where the S&P 500 ends up higher 80% of the time. I don't know why that is. Maybe because a lot of people of Irish descent on the East Coast are involved in stock trading and they just feel good that day. I don't know. Or maybe the hedge funds that are run by leprechauns are working overtime. I have no clue. But the numbers are the numbers, and historically St. Patrick's Day is actually one of the best days, if not the best day, historically on the stock market. So there you have it, some of the catalysts that we will be looking forward to this week in the markets, and some of these could actually make or break the market in the short term. Remember, I'm still bullish for 2021. I do think we will see some problems in 2022 and beyond. That is it for this video. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of these catalysts, whether you disagree or agree with my premise. Sign up if you want access to our private trading group. Link is in the damn description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.